My name is Michael Guyette, publisher of the Lead Lag Report. This should be a really interesting conversation with Mike Alfred, who's got a hell of a following and has a hell of a pedigree when it comes to looking at value investing and talking about Bitcoin. Mike, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, and what gets you really interested in the cryptocurrency space. Let's kind of start off with that.
Sure. Michael, hope you're in Scottsdale and enjoying this beautiful 100+ degree weather.
It is brutal
and
here.
Hopefully you'll even get a hike up to Camelback Mountain. I'd prefer to do Camelback when it's over 100 because there's a lot fewer people up there. Anyway, so my background's a little bit more diverse than most people. I've taken a non-traditional path. I started trading stocks in my Stanford freshman dorm room in the late 1990s with money that I made selling Cutco knives. My experience from the beginning is with my own money, with my own capital. I learned by doing. I didn't work for a hedge fund or an investment fund or anything like that. I just started trading and learning and making mistakes. Honestly, a lot of the stuff I see over the last few years with like Robinhood traders reminds me of stuff that I was learning about, 23 years ago now. Back then, though, you didn't even have real-time quotes. You had to pay or sign up for this thing called free real-time, which would allow you to see the quotes without a 20-minute delay. Things were a lot different back then. Initially was trading, penny stocks, tech stocks, like anything that was moving in the late 90s. Kind of discovered the value investing heritage and started reading more about, bot security analysis, and was reading about Buffett and Graham and Dodd, et cetera. And that whole mindset really appealed to me. And what I realized over time, over the last 20 years, is that the value frameworks, the value orientation can be really helpful across all market cycles. But unfortunately, a lot of value investors essentially stop learning. And so my philosophy today is, value investing without being afraid of new things. And you can see that kind of reflected in a lot of what value investors are doing today, which is owning tech stocks, for example. Right? It was sort of unheard of for Buffett to have something like that in his portfolio 20 years ago. But now, of course, Amazon and a number of other stocks are in the portfolio. Whether that came from one of his deputies or not is sort of irrelevant. The point is that pretty much every business looking forward has some sort of technology component to it. And so if you're a value investor who eschews technology completely, you're probably going to underperform over long periods. That said, if you're just a growth investor and you basically believe the Fed and you believe that everything was real over the last 10 or 12 years, you piled into Netflix, Carvana, Shopify, et cetera, at peak pricing in Q3, Q4 2020 into Q1 of 2021. And now you're down 60, 70, 80% off the highs. And, most value investors essentially avoided almost all of that. It was fairly easy to see looking forward that was going to be a problem. In terms of the rest of my background, though, I started 2 software companies. One was called Brightscope. That was a data business that sold software to large asset managers. So I worked with BlackRock and PIMCO and T. Rowe and Fidelity and those types of firms, helping them understand the retirement business. And we sold that business in 2016 to a private equity-backed roll-up. Then I started a crypto data business, so selling software and data to the biggest hedge funds in crypto, including Paradigm and Polychain and Pantera and Jump and CMT, some of the trading desks. We had DCG and Galaxy as investors. So had a lot of tactile connectivity with the entire crypto space through that business. Our investor base was full of like the who's who of crypto companies. And then I sold that business to NYDIG, one of the biggest Bitcoin brokers, in 2020. Briefly worked as head of strategy and M&A there. Learned the Bitcoin mining business from scratch. I'm now on the board of Iris Energy, which is a publicly traded, NASDAQ-listed Bitcoin miner with primarily facilities in British Columbia. And the business is actually executing really well. The capital markets don't care at all about Bitcoin miners right now, but it reminds me very much so of the internet data center providers from the early 2000s, like Equinix. When you look back at that stock in 2002, nobody wanted that stock either. And now it's one of the kind of value investor favorites. So I look at the business very similarly, because that's basically all you're doing. You're marshaling power and computing resources to create your Bitcoin and kind of secure the network. So that's kind of I could go on, Michael, but I'll stop there and maybe you can jump in.
Yeah, no, that's right. First, I want to hear your thoughts on defining what value actually is. And I know that sounds like a simple question, but I think a lot of people have different ways of quantitatively defining what is considered a value investment. So from your vantage point, what is value, and then how does that really distinguish itself from growth? Because growth can be value too.
Yeah. So look, there's a lot of different ways you could define this. I mean, historically, a lot of investors would focus on book value, right? Or some sort of like classic intrinsic value, like just looking at the assets on the balance sheet. And the challenge with that in modern times is so much of a corporation's value can come from things that are not cleanly delineated just on some line item in the balance sheet, like property, plant, and equipment, for example, which almost feels outdated because so much of the value in the S&P 500 comes from these sort of intangible assets now. And so, it gets harder, right? Because it feels like it used to be pretty easy to define value. You could just look at the balance sheet and you could look at the cash flows and you could say, okay, this looks relatively cheap and I should be able to get all my money back. If I invest in this company today, I should be able to get it back in 14 months. So therefore, I would consider that to be a value investment. I think today you've got to expand your understanding by understanding what the real value drivers are in these corporations. So like for a company like Google, right? The value doesn't come from the building that they own in New York that the engineers go to. It comes from the code, right? It comes from the business dynamics that business is able to create over time and the moat in that business. And so defining it perfectly, I think today is hard. That's why I consider investing to be partially science and partially an art. And all great investors sometimes dance at different times in different ways, even though 10 years earlier they might have thought about it differently. And of course, you're always learning. And so today, I don't try to define value using some sort of like very stratified, very disciplined sort of, hey, this is always going to be value. I try to look at the way the world's evolving. I look at the likelihood of certain outcomes happening. And then I look at each business individually and say, if I buy it at this price, do I believe there's some margin of safety at this level? Right. And I think if you look at all of those factors and you line them up, occasionally you'll see things that look like classic value investments. But again, it's very hard to define that, I think, in the modern time as classically as you could sort of 50 years ago when you didn't have these behemoth tech companies.
No, I think that's spot on because, I mean, data is an asset, and you can argue that data can be hard to value because it depends on how that data is used, right? And sort of the interpretation of that data. Because you've had quite a bit of experience starting companies in the data space, I've always kind of wondered this, Mike. Do you think there's almost an oversaturation of data that is being used or is being considered an asset? In other words, there's always this line that data is the new oil, right? But at some point, there's probably some saturation, and new data doesn't necessarily tell you anything new. Talk about that dynamic a bit, because I think that might be something that is an interesting thought process around defining what value could be in the context of data.
Yeah, I don't know. I actually think that most companies still undervalue their data. Most companies aren't even really using all of their data because there's so much data being created. I mean, over the last 20 years, like the vast majority of all the data created in human history was created in the last kind of 20, 30 years as we've sort of digitized society. Like every device, right, every computer is spitting off data, and it's a massive, massive volume. I would argue that there's probably still a lot of alpha in the data. There's probably a lot of latent value in the data. And that's part of why all of these data warehouse companies kind of came out of nowhere, like the Snowflakes of the world, and were completely overvalued by the market. But the promise of what you can do when you marshal all of the data inside of an enterprise, I think, is a very real opportunity. That said, data can become more commoditized over time as every player in an ecosystem leverages data in a similar way. That becomes table stakes, right? And at that point, you have to keep moving up the stack to higher and higher value data sets or data sets that nobody else has. Like one of the interesting things that you can do in a lot of industries is build a data consortium where you essentially get a lot of different privileged players or large players that have a lot of access to unique data to essentially pool their data together in an anonymized way, which allows you to kind of extract new value from overlaying data from across multiple enterprises that are seeing slightly different subsets of what's happening, say, in the broader economy. And you see people doing that like with credit card data. We did it in the asset management space by getting a lot of these large asset managers to share their distribution data into a centralized warehouse. But over time, like if everybody's using their data well, then data itself ceases to provide a competitive advantage. So I don't know if that's exactly where you're going with it, but that's what I think of when I hear your thoughts there.
Yeah, no, I think that's valid. But data, you can argue, is only matters to the extent that it has some predictive power, right? That you can actually do something with that data to tell you something about tomorrow. I wonder, Mike, if you think there might be some degree of overconfidence or maybe a false sense of confidence that occurs from these companies that are looking at big data to try to anticipate tomorrow's demand, right? Because in the context of markets, at least, um, there was an argument back in the Great Financial Crisis that one of the reasons that you had the housing implosion was because there was all this data around housing, and it created this false sense of confidence, which resulted in over leveraging, which ultimately created the Great Financial Crisis. Maybe you can argue there's some element of that when it comes to Bitcoin and the cryptocurrency space, which we'll talk about. But what are some of the pitfalls that you've seen when it comes to corporations trying to use large data to figure out what to do next?
Well, I mean, obviously there's the base level problem of just if there's bad data going into a model, you can get bad results. There's also the false sense of security that just because something in the recent past worked a certain way predictably, that doesn't necessarily mean it will work the same way in the future, especially at key inflection points. Ray Dalio talks about this in terms of like these long super cycles, not just the business cycle, but like these 50 or 100-year type of debt cycles. I think you see that in technology too, with these exponential technologies where something like a Bitcoin can sort of come out of left field. It's very hard to model that. Like if you had tried to model the future 15 years ago and you didn't know about Bitcoin, you might get certain predictions wrong. So yeah, I think people can get a false sense of security. I think if you have a large volume of data, you can model like 99% of what's going to happen. But there's still going to be things that come out of left field where you still need like a human operator of that system to identify those kind of key inflection points that the data probably can't capture, because sometimes there really are things that are new. They may be amalgamations or combinations of a bunch of things that already exist, but if they're put together in a certain way, like Bitcoin, for example, they can surprise everybody because they are fundamentally different in aggregate, even though there are pieces of what made Bitcoin that existed previously.
Okay, I'm going to hit on Bitcoin in a second, but in the beginning, Mike, you had mentioned that you were learning by doing when it came to trading, and that you were doing a lot of mistakes that you see a lot of these Robinhood investors do. I am curious to hear your sort of list of mistakes that you think newbies do when it comes to trading, and how is it that you yourself, aside from doing, what kind of things would you look at? Would you read? How would you self-educate beyond the sort of education of losses when it comes to trading?
Well, look, I'm not a trader anymore, right? I make trades from my own account, but they're only to add or subtract from long-term positions. I'm much more of a ultra long duration, long-term value investor now, where I wait a very long time to enter a new business, and then when I come in, I generally won't buy a stock at all unless I want to hold it for a minimum of 5 years, but usually more like 10. And so the mistakes I've made in the past are generally around wanting to manipulate time too much, either using options, thinking that I'm smart enough to know when a stock is going to go up or down, or believing that I should use leverage to increase the position size too much, which I did multiple times a decade or two ago, and every time ended up with a poor outcome. And I obviously wish I hadn't done that, but those were good learning experiences, and it's always helpful when you make mistakes with leverage and options, et cetera, with small dollar values, so that when you get to the larger and larger dollar values, you don't make those same mistakes again. Right now, if I look at my portfolio, like it's heavily weighted towards things like healthcare and staples, where they're both kind of defensive and nature, but also like really predictable business models. And they just happen to, over the last kind of 4 years, traded at a discount, right? And so one of the things I've noticed about long-term value investing is that if you track any sector over like 5, 10, 15 years, that sector, sort of independent of the business cycle, will go in and out of favor, right? So I remember energy was very hot for a while, and then in 2014, it just absolutely got clobbered, and it was basically out of favor until about a year and a half ago, right? Healthcare was deeply out of favor for the last few years. Staples in 2018, for the first time in a long time, you could buy Procter & Gamble, Pepsi. You briefly could even buy Coke under 20 times earnings. It's very rare over a 10 or 15 year period. And so my whole thinking around how to invest for the long term on the value side is to not be so tied to a specific sector. Because if you're running a biotech fund, or if you're running a healthcare fund, or if you're running an energy fund, then you essentially you're sort of weighted down by that cycle. You can't bucket because you have to own 100% of your portfolio, or 80% of your portfolio has to be exposed to that sector. And so when that sector goes out of favor, even if you pick the best stocks in that sector, you're likely to underperform the broader market. Rather, weighting your portfolio towards sectors that you know well because you followed them for 5 or 10 years, but you know when they get cheap, right? So you can buy P&G in 2018, right? Or you could buy CVS in 2019, or you could buy pipeline companies, energy companies over the last couple of years when nobody wanted them, but you don't necessarily have to own them, when they're trading at peak prices. In terms of your last part of your question was around like what resources. I mean, for me, it's just following markets every day for 20 years and reading the Wall Street Journal and Bloomberg and reading books, right? Like on my shelf, I have a bunch of the classic value investing books. All of those things have been helpful, but I don't think there's any substitute for just the wisdom of being in the markets every day and reading everything you can. Building companies helps too, right? So if you are just an investor and you've never run a company, you're at a huge disadvantage over somebody who's been a CEO or a board director or who sat on the other side of the table, knows how to run a business. Because then as an investor, you're more able to evaluate statements from management, statements from the board, because you've sat on that side of the table, you know what types of things might be motivating certain behaviors, certain actions. I think it makes it easier to predict outcomes in business context if you've run businesses before.
Yeah, and I think it's interesting because successful entrepreneurs, by definition, have to have a longer term time frame, and if you have that part of your personality is ingrained, right, then that actually I think makes you a successful public investor as well, right? Time frame. Now you mentioned something that's interesting. You said manipulate time and leverage, and it's interesting to combine the two concepts because leverage is a way to make time come sooner, right? You're trying to get gains faster, but it's also where you end up having big losses. Now, I've ranted for a while here around leverage in the cryptocurrency space, and I put out a few tweets basically saying that the problem in the space is not the technology, it's not Bitcoin, it's not Dogecoin, it's not all this. The problem is overconfidence because overconfidence leads to leverage and leverage leads to crashes. And I think we've seen a lot of that in the last, month and a half, 2 months or so in the crypto space. A lot of people are saying that we've entered crypto winter, ironically, around the time that Bitcoin bottomed. I want to hear your thesis on what happened the last 2 months, if you think that this may be nearing its end, and if this is sort of a lesson around leveraging in a very volatile asset class.
Yeah, and I think it's more of a lesson around the credit cycle and what happens when credit goes bad than it is about like Bitcoin or about even crypto. Broadly, I agree with your kind of previous comments. I mean, I was talking on Twitter Spaces. Twitter Spaces was really nascent last June, like last summer. And that was right around the time I left NYDIG. And so I started to use Twitter every day for the first time in my life. And one of the first things I started warning people about in those early spaces in June of last year was BlockFi. And in particular, the GBTC premium to discount trade that had gone wrong and had trapped not only them, but Three Arrows Capital and a bunch of other large investors and trading shops, et cetera. And Celsius was one of the other major, I mean, I put BlockFi and Celsius sort of the same category as these shadow banks that essentially took retail deposits and then ran unregistered, unregulated hedge funds on the back end doing all kinds of crazy shit. So that was a concern I had. And of course, at the time, people were like, well, I get my rewards every Monday, like without fail. How could this possibly be? How could this be bad? And I said, well, it doesn't matter what the number on the screen says, right? What matters is whether the institution that's putting that number on your screen is actually solvent. Because they can tell you have $1 million of Bitcoin there, but if they're insolvent, then you'll never get that Bitcoin back out. And that's essentially what happened. It probably should have happened to BlockFi too. BlockFi got a bailout. But we saw this sort of cascading liquidation situation where a bunch of players, and this is a problem in DeFi broadly, right? Because a lot of these DeFi protocols are literally just creating leverage upon leverage on themselves. They don't actually really do anything. You ask somebody, what is somebody using this DeFi protocol to borrow money from to do with it? And they're just going out and speculating, right? So it's basically creating these layers of speculation on top of each other, which is a very brittle situation. And in the kind of centralized lending space, it was just a bunch of uncollateralized, under-collateralized players taking on too much risk, and it created this cascade situation. I think the contagion part of that phase of this kind of downturn is sort of over. Like most of the biggest players have either already filed for bankruptcy, already stopped doing new loans, right, or they've already received a bailout like BlockFi, and there's a lot less liquidity right now in the entire market because the lenders are essentially like not. They're all saying they're operational, but nobody's really doing anything. And so, paradoxically, now is actually the time over the last few weeks to buy Bitcoin, right? Not when everybody was cheerleading over the last couple of years, but now when nobody wants to talk about Bitcoin, or they're saying Bitcoin's going to go to zero, or it's going to 8K or 6K or 10K or whatever. So I actually, again, don't really care that much about what happens to most of these lenders because I'm not involved with any of them, and I would never deposit money because I don't think you need to get a yield on your Bitcoin. And again, I don't think any of these lenders have anything to do with Bitcoin itself. And so as a long-term kind of holder of Bitcoin who wants to hold it for 10, 15, 20 years, to me, these are just speed bumps along the road of adoption. We were able to get out public in the last week of November after Thanksgiving last year, just before the market started to turn down dramatically. And actually, Rhodium pulled their S1. Core Scientific de-SPAC'd in January, but their stock's gone nowhere but down. They have a huge overhang of different equity instruments, which is unfortunate. The SPAC combined with that, I think, has really hammered the stock, even though their operations are doing quite well. But I focused on the miners that I think can really survive through the cycle, because the challenge, as you know, with Bitcoin mining is like during the good parts of the cycle, these are wonderful businesses and they just like literally print Bitcoin. But then during the down cycle, they oftentimes implode. And so if you can find the miners that actually can survive for multiple cycles, you tend to do quite well as an equity holder. If you make the mistake of buying one of the ones that goes to zero, you're going to give back a lot of the excess return that comes in the boom time. And so, Iris is an interesting situation, right? Because the founders are Australian, Dan and Will Roberts. They've former Macquarie guys, deep, heavy infrastructure experience. So roads, airports, energy infrastructure, et cetera. Their vision was to build like a high quality data center company that just happens to mine Bitcoin. And they wanted to start in markets where there was an oversupply of renewable energy. So British Columbia is a regulated market. The utilities must earn a regulated return. And so as large industry like paper and pulp leaves those geographies, there's excess power. And so if nobody fills that, the end retail consumer actually pays more for their power. And so it's a situation where Iris coming in and building those data centers there actually keeps the cost of power lower, believe it or not, because of the structure of the regulated market. And so our first three facilities there, Canal Flats, Prince George, and McKinsey, they've all come online ahead of schedule. And in fact, I think we're going to have some new deployments kind of going live at Prince George and McKinsey between now and the end of the year. I've been very impressed with the team. I'm just on the board. I'm an independent director, but I've been very impressed with what I've seen from the operating team. They keep bringing these facilities online ahead of schedule. That said, the stock, we went public at 28 and the stock is whatever it is now, $4. And so the capital markets don't care in the short term. The capital markets are not really differentiating between operators that are doing things the right way and operators that aren't. There's some companies in the space that'll probably go bankrupt. The market doesn't seem to know that yet. There are other companies that are doing quite well. The market doesn't seem to know that either. I think there will be some dispersion over the next 6 to 12 months as people start to pick through the rubble here and figure out which one of these miners are actually going to be good operators over the long run. A couple things I'd call out again about Iris. First off is Iris has always sold all of the Bitcoin every day from their operations. And a lot of the miners, as you know, went into a HODL mode over the last year and a half, 2 years. And unfortunately, I was a proponent of that to some degree because I thought, hey, if you're going to own a miner for 10 years, you probably want to accumulate a lot of Bitcoin. The challenge is just if you do that, if you mistime the cycle and you're not selling your Bitcoin every day, you end up having to dump all that Bitcoin back onto the market at the lows anyway, right? Because you run into problems with your debt, you run into problems paying for your machines, your infrastructure, et cetera. The other issue that I've seen is with a firm like Marathon, where Marathon had forecasted having 130,000 machines plugged in by July of this year. I remember that vividly because it's something I cited on Preston Pish's podcast at the end of last summer. And, if you look at the numbers over the last few weeks and months, they've barely been able to keep 30, 40, 50,000 machines plugged in. And the constant, referring to issues with weather and hardened Montana. But the reality is, like, if you don't know how to run your machines, if you don't control your data center environment, if you don't know how to do good heat engineering, if you don't know how to keep online across long periods of time, all of your forecasts are going to be wrong. And then the last thing I would just say is, like, as good as this business looks when things are good, you have to remember that your revenue gets cut in half every 4 years, period. And so this business is going to get more and more competitive. Again, the ones that I think survive, they could be 50 and 100 X's from here, but you got to be careful because a bunch of these companies will go to zero too. Let me clarify and say that the number of Bitcoin that they can mine gets cut in half. And our expectation, of course, without saying it out loud very often, because again, like, we just generally model really low Bitcoin prices to be super conservative. But our expectation is, of course, we think Bitcoin's going to go up over time because it's this finite asset, right? That there's only going to be 21 million, and the number that can be mined keeps going down in an asymptote. And so at some point you get to absolute scarcity. Our thinking is at some point in the near future, the price will be significantly higher. But yeah, so what I'm referring to is the opportunity set in terms of the number of Bitcoin you can mine gets cut in half every 4 years. And actually, technically, it's been a little bit faster than that, and it looks like it'll be a little faster than that again this cycle, because on average, it looks like we're running a little bit ahead of a 10-minute block time.
So, Mike, help me out a little bit with this, because this is something that's been in the back of my mind for a while around this sort of longer term narrative around Bitcoin and the cryptocurrency space in general. So the institutional adoption is happening, but arguably the more volatility there is and the more crashes there are, the slower that process is, right? Because institutions need to model out based on assumptions around expected return around their investments, or at least have the illusion of that. And it seems to me that the issue here is that unless you have some kind of global regulation, some kind of framework around how much leverage you can use in the space, you're going to constantly have these tail events happening. You're going to constantly have these, big ups followed by big downs, followed by big ups, followed by big downs, which makes it, even over time, you can argue a very difficult asset class to hold if you're concerned around big swings like that. How can you really get mainstream adoption if you don't have limits to leverage, which causes those tail events to begin with?
So, I mean, look, it's unpopular with the people that don't like Bitcoin, but the reality is the Bitcoin market is one of the last large-scale global free markets anywhere, where there just aren't a lot of regulatory constraints. There aren't a lot of there aren't a lot of central banks available in Bitcoin to step in and fix everybody's problems, like what happens in traditional markets. So I would say the market's more or less functioning the way it should. Like, we have these market clearing events much more frequently. Like, if you look back to the financial crisis and we didn't just bail out the auto industry, or if we didn't just bail out a bunch of these banks or force bailouts or whatever, right, what would have happened? And my thought is maybe it would have been more painful for a short period of time, but actually we would have had a healthier market with less speculation. Like, we're dealing with speculative bubbles today that are literally just reverberations that are going on for 14 years, because there's no point at which you can turn the Federal Reserve off, or you can turn the ECB off. There's no point at which you can say, hey, please stop encouraging more speculation by holding the price of money at zero. So look, it looks more volatile, it looks more messy, but in fact, in a lot of ways, it's actually more healthy, because people are allowed to fail. Like, businesses that should fail, fail. And if a capitalist looks at a business that should fail and says, I want to own it, like when SBF at FTX says, look, I want to own BlockFi, fine, he can buy it. That's a free market action. He was faster than Goldman or Citi or any other large player like a Coinbase who might have wanted to own that business. So I don't really think you have to force any specific regulation. The market's sort of enforcing lower leverage ratios anyway, right? Like, you used to be able to do like 100x on BitMEX. Like, that just doesn't really exist anymore. These types of market clearing events, like what we've seen over the last few weeks, enforce more discipline organically, because the trading desk and the lending desk just aren't willing to extend that level of credit. Like, everybody learns the lesson every time, and it chastens people. And so I like to see market-based leverage ratios come down. I like to see market-based pricing. I like to see, real market clearing events. And I think a lot of the smarter institutions, like the super long duration ones, they'll actually get to the point of understanding that. And in the meantime, there are a bunch of these people who are just retail holders of Bitcoin who just love Bitcoin, right, from a fundamental kind of philosophical level, and they're not slowing down in their accumulation. So if they continue to buy every single one of these dips, at some point there's just not going to be that much supply that's actually available. And so if the price continues to go up, the institutions are sort of forced to hold it. So I think the market's going to do most of the work. And that may be an unpopular view with like people who love the Federal Reserve and they love the US dollar and they think the US dollar is the greatest thing ever and everybody should own, treasury bonds as a big part of their portfolio. But I think it's going to end up being right over the next 5 or 10 years, even though it's unpopular right now.
Well, in fairness, I don't think too many people love the Federal Reserve. Anyway, regardless of that.
I mean, one of the benefits of a truly decentralized system, and maybe one of the main things that Bitcoin's sort of done right so far, is this idea that like there's no single person that controls it. Most of the technology components of Bitcoin are built up from other existing technology stacks. It's sort of like a community asset in a sense, right? Because you don't really require any IP. Like it's sort of like the internet itself. Like you can't really shut it down. You can't really control it. There's no one source of control. I mean, China can shut down the internet in China, but they can't shut down, Americans' ability to use Google if they live in Toledo, Ohio, right? And so I'm not sure that angle is really going to matter because the main question I have is just, is Bitcoin still around in 5 or 10 years? And I don't think intellectual property is an important part of that question, because if Bitcoin's still around in 5 or 10 years and it's thriving, then my view is, given the scarcity of it, that there's probably going to see higher prices in fiat terms. And that's it. Like that's what I'm interested in. And so a lot of my time is spent on figuring out what could cause Bitcoin to fail, what could cause Bitcoin to not work out, what could cause people to not want to hold Bitcoin. And even in times where the price goes down 80%, people seem to get more excited about owning Bitcoin. And the hodlers, the people that actually believe in it, they get more convicted around the long-term view of why they would use it. And frankly, like given the geopolitical issues right now, like with Russia and Ukraine, for example, like I think that was a wake-up call moment for a lot of traditional people to say, wait a second, like these currency reserves that we all kind of gave Russia credit for, they didn't really exist when they needed them. Because if somebody disagrees with you in a geopolitical spat, apparently, like if you disagree with the US or you disagree with Europe on something, Western Europe, then they'll just take the money from you. So this use case of just needing this neutral reserve asset is quite powerful. And I think it's not just a meme. It's like something that if you live in some of these countries where you've experienced any sort of financial instability, right, where hyperinflation or governments that are just taking advantage of their citizens, the attraction of having this kind of neutral reserve asset is quite high. So again, IP, like maybe it's interesting on the fringes. Like if you like following salacious details about kind of crazy people like Craig Wright, fine. But to me, that's like not the interesting part from the investment use case. One of the probably best criticisms of Bitcoin to date is that it's actually very hard to use as a currency, right? It's hard to use in your daily life, at least historically. There's tax considerations. Like if you actually use Bitcoin to buy coffee, like it could be a taxable event. That would all change if it was recognized as like it is in El Salvador, right? If it was recognized as a standard, like as a unit of account, for example, then you wouldn't necessarily have a taxable event. And then there's things like the Lightning Network now, where you could actually, it's sort of like a batch processing type of way of using Bitcoin, so that you could actually do a lot of transactions without having to reconcile back on chain immediately. So there are approaches that people are working on, but it is fair to say that for the most part, the best use case of Bitcoin today is to buy it or mine it or acquire it somehow and hold it in cold storage, hold your own keys. And so you've essentially truly unbanked yourself. You don't listen to Alex Mashinsky at Celsius because he was lying. He was just another poorly run shadow bank. But if you actually hold your own keys, you really truly did unbank yourself. There's no counterparty at all involved. You're just holding your assets directly on chain. And that use case by itself, if you are poor, or if you are in the middle of Central Africa, or if you're in Argentina, or if you're trying to flee some oppressive regime, or if you're just a government, right, and you're trying to hold some neutral asset, that can be a valuable use case, even if you're not using it to transact. But I think in the long run, to have healthy Bitcoin ecosystem, there needs to be a lot more infrastructure built up around actually using Bitcoin in commerce. And I think that will come. I mean, that's what we're all betting. I mean, this whole space reminds me of investing in the internet stocks in the late 90s, early 2000s, where it was hard to imagine at that time buying a car or an airline ticket using the internet. Now the internet's completely ubiquitous. Like you literally can't operate in the modern economy without it. And if you're operating without it, you're probably not doing very well. And I think I have a similar view of like where Bitcoin could be 10, 15 years from now. And I think some of the Web 4, Web 5 stuff is just almost like a meme. Like a joke because people are annoyed at the Silicon Valley VCs for trying to take something great in Bitcoin and then creating these convoluted schemes, essentially that, in large part, mostly fail and steal money from retail, essentially. And so this joke of Web 4, Web 5, Web 6 is almost like, hey, like if you can do Web 3, then I can do Web 4. Where I think Dorsey's real focus is on just making Bitcoin easier to use and more accessible. I mean, a lot of the issues that individual users have with Bitcoin are just like fundamental usability issues. Sort of like when you first accessed the internet in the mid to late 90s, you would use a dial-up. It was a very slow process. The pages wouldn't load. There were a lot of scams and frauds. Like there weren't a lot of good portals, right? And so eventually you would use AOL and as a safe way to access the internet, or use Yahoo, right? And then people would learn that if you got an email from a Nigerian prince, like that's probably not real. Like you don't really have money in Nigeria. The same thing's happening with Bitcoin. And so while Bitcoin itself is great and it's a great long-term tool, just like the internet, there's a lot of usability issues. And I think Dorsey's trying to address some of those things. Like how do you make it easy for the average person to hold their own keys without the risk of just outright losing the key, making a mistake on the technology side, having your house burned down and losing your Trezor or your ledger, right? Or being able to run your own miner at home. Like that shouldn't be so hard. Maybe it should be easier to do that. So these like basic usability issues so that everybody can have access. I think it's about creating accessibility and better usability. I think that's really what the focus is on.
I don't know, man. I made a lot of money from those Nigerian princes sending me emails.
The reality is, like, for these decentralized systems to work, there's usually like a rough consensus that comes from the interaction between the users, the miners, the people who are running the nodes, and kind of the original vision and the original code, and then people's interpretation of that. Because obviously there are minor changes represented in soft forks constantly in Bitcoin that are rolled out by the core developers, and some of those things can be quite contentious over time. But I think at a very high level, the thing that gives me confidence is that there seems to be enough of a kind of shared understanding culturally of what the purpose of Bitcoin is and also just like a resistance, a strong cultural resistance to major changes to the protocol, that it's highly likely that what you view as Bitcoin today will be the same thing that you view as Bitcoin in 20 years. It'll be essentially alike without any major changes to like the things that make Bitcoin special, like the hard supply cap, et cetera. But it is a rough consensus, and it is possible at some point in the next 10, 15, 20 years that like certain interests that gain enough control of the network or various components of the network, either through the mining side or through running a certain number of nodes or holding enough Bitcoin, that they could potentially influence the direction of the protocol, because it is a living thing, right? It's not a static thing. I think a lot of people view Bitcoin as a static ecosystem, but it really isn't. I'm not the expert in knowing exactly how that plays out, but as I understand it today, it would be very hard to change most of the kind of fundamental things that give Bitcoin its unique value in the crypto ecosystem. And my current recommendation to people coming in is that like 80 or 90% of your crypto portfolio should just be Bitcoin, because Bitcoin is the one thing that if I look out 10 years, I think will still have tremendous value and potentially substantially more value. It may not appreciate at the rate of some token I've never heard of today that is worth 0.00001 cent. But buying those things today is like buying a lottery ticket, whereas Bitcoin to me is like just buying the S&P 500. And it's a crude analogy; it's not perfect, but if you're new to crypto and you don't know any better, I think the best way to avoid hurting yourself is just to own a lot of Bitcoin. Let me be clear about one thing. Like I may be a probabilistic investor and I recognize there is a chance of failure, but I do believe right now the biggest risk in the entire world that an investor can make in July 22nd, 10 a.m. Pacific, right, is to not own any Bitcoin. I think it's the most it's negative asymmetry, right, to not own it. And so I don't go around saying you should have 50% or 100% of your portfolio in Bitcoin. And I think it's fine to have 1% or 5%, depending on where you're at in your life and how much capital you have. But I think zero is going to end up being a huge mistake. That's my view. So you're giving me credit for not saying that, but I do think that is a mistake not to own Bitcoin.
Well, and by the way, on that point, owning the market doesn't mean owning the S&P. In the purest form, owning the market means owning everything, which means also owning Bitcoin. That's why I think people misinterpret a lot of my comments over the last year and a half or so around the store value narrative, which I really kept on hitting over and over again. It's not that you shouldn't have exposure. It's about how much exposure, right? And my contention is that narratives cause people to overweight relative to volatility and their own personal risk tolerances. And that's where I think people get into trouble. Aside from Bitcoin, let's go back to value. You had a very big drawdown in a lot of things. A drawdown that, by the way, has, as I've been very public in saying, has very much hurt my own world from a risk on, risk off perspective, because in my world, risk off is treasuries. In my world, treasuries tend to outperform equities when you have big drawdowns in equities. That was not the case the first 6 months. Risk off acted risk on in a very much an unusual way. Maybe there's value in the relationship reverting back to treasuries as the safe haven play. Who knows in that high volatility? But Mike, aside from Bitcoin, not investment advice, but are there certain longer term investments that you think are really interesting values here, given the way 2022 has played out?
Yeah, and actually, it's been a quite good year to be a traditional value investor with low multiple, particularly dividend payers, which is what I've been skewing towards for the last couple of years. And I also want to add that I got a chance to meet Bitcoin Tina in Miami, and even though we had words online previously, we got along quite well in person, which is usually the case in my experience with Bitcoiners. A lot of yelling on the internet and a lot more.
I will echo that real quick. I wish people would. It's like two different worlds, right? People want to attack online, but in person, they actually seem fairly friendly, which is why I like doing spaces, because you actually get to talk to somebody. But anyway, go ahead.
Yeah, so large positions right now, like I really like the pipelines. I think, especially natural gas, like that's a 20-year story. We need a bridge fuel. These are toll booth businesses. They're not taking a lot of commodity price risk. So like if you go with like the highest quality names, like an enterprise partners, EPD, like I put a tweet out on January 3rd. I bought whatever it was, 7,500 shares at 22.48, I think was the price. It's at 25.81. It's still relatively cheap. I think it's a $30 or $35 per unit. In the meantime, you get 7.5% type of yield. Me and Len Alden, we've been hammering on Bristol Myers Squibb for about a year and a half now. It's up 20+% for the year to date. It's still trading under 10x earnings with like a 2.5% yield. Recently, I was buying Carl Icahn's vehicle, IEP. It still looks relatively cheap to me. It's got close to a 16% yield. The only reason why that yield is sustainable is because Icahn doesn't take his yield in cash. And so it's only like 8% of the units outstanding that take a cash yield. So it looks like a 2% yield to the company, but it's a 16% cash yield to you. I think that's a nice way to cushion downside. And then the last thing I'll mention is just staples, right? So like Pepsi and Coke are a little expensive, but Heineken is still trading at like 19 times earnings, and I think it's one of the highest quality staples companies in the world. The Heineken family is still a large shareholder. I like Constellation Brands. They're the one company that owns Corona, Pacifico, and Modelo brands in the U.S. And then there are a couple of like financials type of name, like life insurers, like Prudential, look interesting to me at these levels. But yeah, there isn't that much, right? Like two other names real quick. Target was expensive at the beginning of the year, but looks a lot cheaper here after the sell-off. And then Medtronic, which is also a dividend aristocrat, that was much more expensive, 3 to 6 months ago, and has gotten relatively cheap. So I'd be continuing to hide out in those names because I don't think it matters whether the S&P goes up or down. If there's more shocks, those are companies that will be fine and will probably outperform the market in the downturn, but more importantly, have 10, 12, 15% in some cases compound growth in front of them, in my opinion, over the next decade.
I think that's a great way to end the conversation. Everybody here, please make sure you follow Mike Alfred This was my third space of the day. Hopefully, I was somewhat coherent. I am now running a bit late for another call after I'm going to have a late night flight, unfortunately here. But thank everybody for joining. Thank you, Mike. Thank everybody for participating. And I will do as usual another space tomorrow. Enjoy the rest of your day. Thanks, Mike. I appreciate it.
Thank you, Michael.